Welcome back to another Roundtable. My name is Adam. I have Rusman.
Hello.
Victor.
Hi everyone.
Once again. And today we're going to talk about REITs, and Singapore REITs specifically.
Yeah.
Because a lot of them are near COVID valuations when everything was very, very cheap. And some of them even have double-digit yields. So
Yes.
we're going to have a look at whether there maybe one or two of them we want to have a look at, and maybe there's some of them you should avoid even though they're paying such high yields. And why is that so? All right, so maybe just a quick overview of what the REIT market is like in Singapore right now.
I think if you look at their yield on average, if I were to just base on the SGX chart book, which I think they release on the monthly basis, where they talk about the average property trust and they compare their performance. I think if you look at the average 42 S-REITs and property trusts, it as of 31st of August, a bit dated, okay, at the time of this recording, the average yield is about 7.5%, okay, but with the recent sell down, I actually looking at this yield to be around 8%, okay, or even higher, right? And if you look at compare this with the 10 years government bond, which is about 3.3%, there's actually a spread about close to 4+%. Okay, so and historically, I think of course if you look at the spread, usually when it's near 4% or 5%, usually that is the time where it becomes very attractive. Okay, and this is despite the fact that I think the 10-year government bond yield has actually expanded. But of course, if you look at the forward yield that I think SGX chart book actually presented, they don't seem like to be at the historical high. Okay, in terms of yield, largely because they have excluded the outliers. Some of the outliers like your US-based REITs, which have I think double-digit yield, 20, 30, 40% yield, 40%. That kind of level. Yep. Yeah, so they kind of exclude them out.
Because they kind of skew the results.
Yeah, you kind of skew the result. If you throw this all in, I think if you base on historical data that we always pull, the average yield is hovering in between 11%, the whole sector, just the REITs itself.
Okay.
But bear in mind that I think the data that we collect from our website, sreits.fitperson.com, is based on their full year DPU, full year NAV. Okay, so some of this DPU may be already cut. Okay, like what we've seen with some of the REITs that have announced with their DPU suspension. Yeah. So but I think I will still prefer to look at the price to book basis, but that kind of gives you an idea where they are in terms of NAV basis, right? Compared to the prices that we were trading on a whole sector basis. I think you are looking at near historical low valuation, right? So this is very close to the COVID sell down during the pandemic at the time, and a lot of REITs actually got into sharp plunge because of leverage, one of them, and then secondly because of the panic selling that the market is actually we've seen across the board at that point of time. Okay, so now in terms of price to book, the whole sectors we are looking at about 0.8 times, and COVID at that time was about 0.8 times to as low as 0.7, but that only happened like in a very short time frame, I think in a week or so, right? So and then they quickly rebounded. So now we are in the situation where the whole sector for REITs are quite depressed. Okay, so which I think is also always the time where we will come in and take a look. Hey, there might be opportunities.
Yeah, because I think Victor always likes to say, you can't have a good outlook and a good valuation at the same time. Yeah. It's times like these when it's uncertain, no one knows what's going to happen, looks a bit like iffy, that this is where the opportunity lie. And it's really, as an investor worth your salt, this is the time for you to come and go in and look for a good opportunity.
There's always some quality companies inside that also being pushed down because of all this whole thing, because it's the whole sector going down. But there's definitely, it's not everyone is bad, right? There's always some good one inside.
So if you've seen those REITs that are hitting 52 weeks low, I think if you look at those that have been whacked badly during this rising rate environment, which is one of the main reason for the recent sell down. Like you have Tasin Retail Trust. I mean, this is a business trust, right? And it's come down about 70%, right? So, and EC World REITs has come down about 40% based on 1 year total returns. Elite Commercial has come down 50%. And then of course you have your US based REITs like Capital Pacific, Old Manulife US REITs, Prime US REITs. All those has come down 50, 60, 80%.
Yeah, that's a massive crash.
It's a massive crash, right? And so some of these are actually badly affected because of the fact that the rising rate actually pushed their interest rate actually go higher. And the other reason, of course, we covered this before. I think we talked about office US REITs previously.
I think in February
this year.
Yeah.
This year. Okay, so we did highlight that there's a fundamental issue that going on in this industry because since the pandemic happens, I think there are a lot of people getting used to like working from home, and the demand for office space in the US kind of like dropped significantly. I think not many people are going back to the office as they used to be, like 3 times or 5 times a day, right?
Yep.
So that kind of leads to a huge oversupply situation in the US that we are looking at, right? And plus the rising rate with lower demand, I think that kind of like double whammy for the whole sector. And then that actually resulted some of these US based REITs to see, I mean, we've seen their prices drop quite significantly, right? So this is a sector that I think the yield now, you look at them is based on our data that we have, I think they are the 3 highest one is actually like Keppel Pacific Oak 26%, Prime US REITs 52%, and Manulife US REITs is about 80%. Okay,
80% yield.
Yeah.
Wow.
So of course, this DPU is likely going to reduce significantly.
Okay.
Or pause. I think in the case.
Yeah,
of
and I
Manulife,
think during the February time when we shared, the average yield was 16.4%.
Okay.
Right, and right now it's like even higher. It's not because that they increased the dividend, but rather the share price have reduced.
So we highlighted this back in February. We said this was don't look at these US REITs because it's going to be a very shaky situation.
Yep.
Probably going to get worse.
Yeah.
And it got worse.
It got worse.
It got worse.
Yeah, worse.
But then someone could look at this, maybe a beginner will say, hey, 80% yield, man. I just need to hold it for 1 year.
Yeah.
I might just get my money back and then wait a little bit more. And I mean, someone at 50% as well. It's very, very high yields. What would you say to someone like that? Why should they avoid these kind of REITs?
I think at this stage, it's highly uncertain. For the sector to recover, we still don't know when that is going to happen because the pace of recovery for people going back to office in the US are not getting any traction. This is despite the fact that some of the big companies have tell their employees to go back to office, but they are still not really following through the order. Okay, and yeah, so I think my advice is stay out of it because it's still very shaky, and even if this sector were to recover, it's going to take a long time. Okay, so probably maybe 5 years down the road. Okay, it hasn't even bottomed up yet at this stage. But of course, if you still are very opportunist and you want to look at it, of course, go for the one which we talked about it in the previous video. So the one with the most financial muscle, right? The one that is a solid one. I think Keppel Pacific Oak actually stood out. But again, you got to prepare for another 50% drawdown because
it could happen, right?
And there's no recovery in sight at this stage. Okay, because there are still reports saying that valuation across the boards are coming down, and that will affect their gain ratio. They will trigger the interest coverage, and that is exactly what we've seen with Manulife US REITs. That financial convenience is actually being triggered. Okay,
so it's a very risky play. You're saying just don't get carried away by the high yields you see because dividends could get cut some more. You won't be getting that sort of dividend moving forward, and the recovery is you don't know how long it's going to take.
Yes.
So you avoid those kind of REITs.
I think I would personally avoid.
Yeah, I think most people would as well.
Yeah, because I don't know. The key question is the survivor now. Right? You don't know whether these REITs can really go through this down cycle. Right?
Yeah, I think recently there's an article also mentioning that the US commercial property is also having very, very big crisis right now.
Okay, so you avoid these kind of REITs. But then at the same time, you're saying that the whole sector is dragged down. There's still going to be high quality REITs that are doing well. Fundamentals are still very, very solid. Which ones would you highlight at this point?
No, we have to go through the list down. As you move down, I think you saw with elite commercial REITs is also giving you about 19%. I think this REITs also got recently affected by the higher borrowing costs. I think we saw in Europe, and the sudden rise of interest rate actually affected their borrowing costs. Okay, so this elite commercial also will see more pain to come because as some of the loans matured, which they took on before the pandemic, all right, and at a lower rate. Now it's actually seeing at a higher rate, right? So that there will be more pain to come. So I would continue to go down the list. Of course, you may have seen some of the REITs that gives you 10% or 12%. Those are still a higher risk basket. Okay, I mean each one of these REITs have their own issue that they're dealing with, right? So I will personally basically go straight to those REITs that are giving you 7% yield or less, and look at those basket, because those REITs are better in terms of quality. And of course, you don't look at those REITs that have paused their dividend. Of course, that will be under less than 7%, right? Yeah, like in the case of EC World REIT, and of course you have Dasin Retail Trust, which is a business trust. Those have their tenants defaulted, and because they have a counterparty risk, which eventually triggered their largest tenant actually they never pay up, right? So they couldn't pay up the loans, and then now they have default.
Okay.
Right, defaulted some of those loans, right? So perhaps let me go straight to the point here. Okay, which is the REITs.
Yeah,
I think
which one
people has been waiting. Rusmi, you go straight to the point, please. I think the one is my favorite is actually CapitaLand Integrated Commercial Trust.
Okay.
Right. So this REITs previously was actually CapitaLand Mall Trust. I held it through, and then it subsequently merged with CapitaLand Commercial Trust. Okay. So it was a pure retail REITs, and then subsequently it has merged with Grade A offices REITs, right, which is CapitaLand Commercial Trust. And now they are basically a combination of retail and office, and a bulk of their assets are primarily in Singapore. Okay, and of course, let's look at some of the assets that they own. All right, they have Bedok Mall, all right, Bugis Junction, Bugis Plus, IMM Building, Junction 8. I think Tampines Mall. I've been to some of these malls, and I think they are usually generally very crowded.
Yeah.
Over the weekend, and they also have like prime Grade A offices like your Capital Tower. Capital Sky, 6 Battery Road, these are your prime CBD area in Singapore, right? So very, very good assets. And of course, you have integrated developments like your Plaza Singapura, Raffles City, which is another great asset. I think a lot of them are good assets actually. And then you have Funan, which has been redeveloped, right, from the previous old Funan IT Mall. Yeah, so these assets are very solid, and if you look at the occupancy, I think they actually been hovering above 95%, above 95%.
That's very high
on average.
Yeah.
Right. So that kind of gives you the clue that hey, look, they have this good asset in the good location. Tenants are willing to pay for this kind of rent for this kind of location. Okay, so they are well occupied. Right, and so Singapore retail, if you talk about suburban and downtown with malls like your Orchard, okay, it's actually made up about 50% of their portfolio, more than 50% actually, right? So slightly more, and then the other 27% is actually the Singapore CBD office, and then the 6% is actually the Singapore hotel. Okay, so if you look at it, these REITs, I think essentially almost 90% of their assets are based in Singapore. So when you have REITs that are based in Singapore, collect rental income in Sing dollar, you don't really have that currency risk. They do have asset in, I think, Germany, Australia. That part will be exposed to the currency rate fluctuation. And I think with Sing dollar has been strengthening against a lot of other currency, we actually have seen some REITs with heavy exposure in overseas market. When they translate back their income into Sing dollar, actually it's a lot lower. Like what exactly happened to Taiwan Logistic Trust, which is a Japanese logistic REIT. And then because of the yen, I think weakened against Sing dollar so much because of their tight monetary policy, right? That kind of like affected their DPU. And then I look at the rental income in JPY, it's still solid. Okay, so for back to CapitaLand Integrated Commercial Trust, I think if you look at their top 10 tenants, you have Raffles Hotel, which is one of their anchor tenant. We have WeWork. Of course, now this is a big question mark, but it's only account about 2.4% of their portfolio. And of course, your NTUC, GIC, Temasek. I think those of you who don't know, they are the Singapore government. All right, and so it's very solid tenants, the top 10 tenants, and it's very, very diversified. They have, I think, a lot of tenants in their portfolio, right? So so if you look at the qualitative aspect, I think some of the leases that they have actually renewed recently across the board for their retail portfolio, they have actually seen a positive rent reversion about 6.9%.
Okay.
On average. Okay, so that rental increment will comes in over the next 2 to 3 years. Okay, when they sign these leases, right? So and there will be a rent increment that basically you see with this particular REITs. And then of course, if you look at their tenants traffic. All right, shopper traffic and tenant sales, they have also seen their tenant sales exceeded the pre-pandemic level, right? And traffic, of course, is still recovering, but I think tenant sales is the main important metrics that I looked at, because if your tenants are doing well, usually you can increase the rent.
All right. So basically, CICT has high quality assets in prime locations. They're in high demand.
Yes.
So tenants are always looking for, to rent their space.
Yeah.
And you have high quality tenants as well.
Yes.
So it's a very stable REIT.
Yeah.
Based in Singapore, so you collect in Sing dollar.
Yeah.
You receive your dividend in Sing dollars as well.
Yes.
So everything is just solid in that sense.
Yeah. So this REITs, I think if you go back 2 years ago, it was affected by the lockdown, right? Pandemic, and they have to give up rental rebate 4 months, and some tenants get even more, right? Those are heavily affected by the lockdown. So some of those leases were signed during those pandemic time. So it could be a bit depressed, some of the prices that they leased out. So with the lockdown now is gone, and tourists are coming back to Singapore, I think you get to see that with their shorter leases, about 2 to 3 years for their retail side, I think you get to see some of these leases being renewed. That's why you see a lot of good positive reversion there, right? So there's a recovery play that is actually still ongoing with this particular REITs. And on top of that, there isn't a lot of supply when it comes to shopping mall in Singapore, right? I mean, if you go to Orchard, there isn't any new malls being built because there's no more space.
There's no more space, yeah.
Okay, so if you own one of those prime assets, usually the choices are a bit limited, okay? And on top of that, so a lot of their malls are in the near train station or bus interchange, right? It's very prime. And besides that, that's for their retail portfolio, right? Then you have, on the other hand, you look at the office portfolio, which I think at this stage, the Singapore CBD area is facing a very tight vacancy, right? So meaning to say that there's a very shortage of supply of office space in Singapore CBD area. Okay, I think you're looking at the low single-digit average vacancy rate. I think about 5.2% as of second quarter of 2023, right? So it's very tight. So usually when you have a vacancy rate of less than 10%, it's a landlord's market, right? So it's up to the landlord to dictate how much they want to charge you. If you don't want, you can go find other space, and you don't really have a lot of options.
So it's entirely opposite of what's happening in the US. So in Singapore, is that people are just still crammed in this space. There's nowhere you can go. So if you want a great office in the CBD, this is your choices, and that's it.
And in terms of culture, also a lot of Singaporean, I think, have gone back to office.
The boss is saying you got to come back to work. Even if you're not doing anything, I want you to sit in the office so I can see you.
And Singapore is a very small country, so it's not like like US, you have to drive hours, traffic jam.
Half an hour, 45 minutes, normal.
So Singapore is really like, so back to office is like a norm nowadays. And I used to see my sister-in-law working from home every day. Now I've never seen her anymore, except the weekend.
I think you can look at the number of passenger in the MRT, you know already, right?
So I think in terms of that tight vacancy will helps with the office rental over the next. I mean, recently has weakened because of a lot of macro uncertainties. But this trend, I think, is likely going to continue to edge up, okay, as we move along. But provided there's no big financial crash, okay, because if there's a big financial crash, then obviously we'll see rents start to coming down again.
But that will affect everyone as well, right?
They will affect everyone, right? But if you look at the average expiry rent in their portfolio, on average is about $11 for 2023, the year. So the whole portfolio that's going to expire. But the current market rent is about 11.8. Okay, so it's still below that, right? So meaning to say if they renew some of this rent, there will be a positive reversion, right? And 2024 is even lower at $11. Okay, so or slightly less, okay, $10.99. So this will provide recovery for them, not just in retail but also office. Okay, and with that tight vacancy space and limited supply in retail, I think that will provide a very solid recovery path. Slow but steady. But of course, we have the interest rate cost coming up, and if you look at the CICT, I think that you have to look at the capital structure, right? You want to make sure that they are not overly leveraged. And in terms of aggregate leverage, they have about 40%, which is decent. Right? I mean, it's reached the line where I'm comfortable with. Once you start to go 45%, I say, no, this REIT is too risky, too much debt, right? And then they have percentage of their borrowings are fixed, about close to 78%. Okay, which means that the higher rate does affect them, but it's in tranches, right? And then some of these loans will going to expire in the next 2 to 3 years, or for some of the loans, the actually average maturity of their loans is about 4.3 years. Right? So you get to see that their loans maturity actually spaced out evenly, right, until 2030, and then it starts to slow down. You see some loans stretch out all the way to 2031, 2033, right? So basically, they will get affected by higher interest rate, but it's very slow. Okay, based on the tranches.
They basically spread out that effect on them.
And they have been gotten used to paying a higher rate compared to some of the REITs that put their loans mostly on floating. Right, so they have enjoyed low rate, for the last few years, right, or 10 over years. Now with a higher rate environment, CICT has actually been paying that kind of high rate all the while. Right. Of course, they will still get affected because now if their fixed loans mature, they have to refinance it with a higher rate, right? So that will affect them, but it's slow and steady. But with the rent increment that coming in, of course, that will be able to. I'm actually expecting that to offset some of this cost pressure. Okay, hopefully, utility costs start to stay the same or come down, right? If you continue to go up like what we saw in 2020, 2021, the supply chain issue, of course, that will. Put a lot more pressure on their DPU, distribution per unit.
All right. I think that's the question that any REIT or income investor, they say, look, you're saying all these things about CICT, the macro factors look good in Singapore, rent reversions look positive, and the interest rates look like they can manage it pretty well. So does this all mean that they are able to at least maintain the dividend moving forward? Because that's the main thing for income investors.
Yes. I think that's why I highlighted these REITs because I think that they are able to withstand this current stretch, but you don't expect their DPU to grow high single digit. Perhaps they can still grow. If not, at least worst case, if the rate continue to go up, which what Fed or a lot of people are saying, right? It will continue to go up or stay for a while. I would expect them to stay they keep their DPU, right? At least flat.
Yeah. So they just maintain it.
Yeah, next 2 to 3 years until the rate start to revert. Once the rate start to revert, obviously we'll start to see less pressure on their interest costs, and then that's the time where they can start to you may start to see more uplift in terms of distribution per unit. So and in terms of interest coverage, this one also is quite solid. It's above 3 times. It's about 3.3 times. I mean, obviously if I have 5 times, even better, but this REIT currently stands at about 3.3 times. Okay, so average cost of debt now they're actually hovering about 3.2%. Okay, so financially I think that they are quite strong, okay, but they are not the best in the industry, of course, right? But given that this REIT is currently at this time of recording is trading at about $1.77, that DPU, if we based on last year FY 2022, I think 10.58 cents, that will gives you a 6% yield.
Okay, pretty decent,
Yeah, of course you can invest in short-term treasury 1 year, but the yield is high, 3%, 4%. But that only lasted 1 year, right? We don't know what's going to happen next. But with this REIT, that it's going to give you that 6%, and with the quality that you are getting, chances are high that they are able to maintain at least that DPU. But of course, if things get worse, DPU may come down slightly. Then you have to prepare for that as well. Okay, so there's an equity risk that you need to bear in mind.
Yeah, I mean,
look at.
I mean, one is fixed income, one is equity. Yes. So there's upside as well. That's why you look at something like that.
Yeah. So I mean, interest rate can change anytime, right? I mean, it can go to zeros overnight.
So who knows, right?
And you don't know when that's going to happen. But don't just invest in one single REIT, okay?
Yeah.
And this REIT I think that are able to sustain that DPU in the current high rate environment. Is one of those quality REITs in my portfolio. So I'm biased, so you have to go and do your own due diligence. And of course, this is not the only REITs that I hold, right? So you have to diversify across a few REITs and or a few other income stocks if you're looking for passive income.
All right. Yeah. I mean, we just wanted to highlight maybe one REIT, that's despite the troubles in the industry and the high interest rates, it's still going on it's still chugging along very nicely. Paying a dividend, it's stable, managing the interest rates very well. So once again, no recommendation to buy or sell anything. Please do your own due diligence. Find out if it makes sense for you, but it makes sense for you, right, Rusmin?
It makes sense.
Yeah, is this one of the REITs you have?
Yes. Yeah. So this is one of the REITs that you can take a look, right? If you're interested in the relatively high yield type of REITs. 6% I think is not fantastic if you look at the current 10-year government bond, which 3%. But 1 year Treasury is about 4%. In the US, you're getting about almost 5%.
Okay.
Yeah. So, but it's still a better yield.
Okay, it's still a better yield. And if you like REITs and you believe in the recovery play,
yes.
I mean, not a quick recovery play, but a midterm kind of recovery play. This is something that some investors might be comfortable with as well.
Yeah.
But I guess the main thing you want to point out is that, look, this is a solid REIT, and despite the circumstances, and you don't want to have a look at those REITs that are giving you double-digit yields, because those are just, like you said, they're gone.
They're gone.
They're gone.
I can't say all of them, but I think the one that have a lot of pressure with fundamental issue in the industry that they're in, I think it's very difficult for them to come back.
Yeah, it's a bigger hole to climb out of.
Yes, it's a big challenge, right? So, because there's very little things they can control, right? If it's an industry problem, everyone is having the same issue. All right, you need the demand to come back quickly, but it's not coming back. Yeah, and there are some REITs that have tenant issue. The anchor tenant never pay up, and then that's going to default the whole thing, and the whole thing may just collapse.
All right.
Yeah, what we saw with Tasin Retail Trust and then EC World REITs. I mean, those are problematic REITs. So try to avoid those extremely high yield REITs because they are very risky.
Okay, so again, it goes back to quality in what you're buying. So whether it's REITs or just like a regular company, always goes back to quality and what are the fundamentals, how they're affecting it, how do they respond to the environment. And CICT looks like it's pretty stable.
Yeah.
And giving a very stable yield as well. Looks likely that it can maintain its DPU.
Yes.
All right. So I mean, again, anything could happen, but it looks very solid. All right. So again, if you want to have a look, do check out yourself. No recommendation. Is there anything else you want to share?
I think actually, if you ask me the question whether can they maintain the dividends, right, in 2019, I would say yes.
Okay.
And then COVID came.
Yeah, but that was like who knew COVID would happen, right?
So I think back to the point where anything can happen, right? So that's why it's important to diversify your risk.
Okay.
Yeah.
All right.
Yep.
Okay.
So again, I mean, that's the risk when it comes to investing.
That's investing.
Yeah, that's investing. You just kind of go with the probabilities and what you are comfortable with.
Yes.
There's no 100% probability.
Yeah, there's no 100%. Maybe CPF, I don't know. Okay, so is there anything else you want to share about?
Yeah, that's all.
That's it? Okay, so if you like this roundtable, please hit the like button. Any questions about CICT, you want to ask about anything about that, put them in the comment section. And of course, my name is...
write into them.
Write in?
Yeah.
Oh, you can investor relations.
Less work to do.
Yeah, some people may not know that, but you can actually email investor relations for any company and ask them the questions you have. Just email them. A good investor relation team would handle all those queries.
Yes. I think it will give you better information.
And I mean, that's another way to do your research, because if a team is very proactive in managing your questions from the public and everything from investors, it shows that it's quite well run.
Yep.
Some teams may just ignore you because no one knows what's happening.
Yep.
So it gives you insight into how the company is being run as well.
Yes. Yeah? You should get a response from CICT.
Yeah, you should. Yeah. Okay. So with that, my name is Adam. This is Rusmin. Yep. Thank you so much for sharing all the data and research. That's Victor. Thank you for joining us. And of course, subscribe to our channel. Many more roundtables coming up, and we'll see you again.